Just give it 1 or 2 minutes. And Angela, did you do yours as well? Cool. All right. So welcome to the OMNIPool Final Presentations. Super excited to wrap up this program today. We'll give it maybe another minute, let a few people trickle in, but it's great to have everyone. I can only see a few of you on my screen, but I'm sure you're all enjoying it. Cool, and hello to the new folks that are just joining.
Hi, everyone.
Hi, Paulina.
Hey, Paulina. All right, we've got our anchor too. Rudy, how's it going?
Everything perfect. Simulations work.
Awesome.
Some small coding errors, corrected everything.
You fixed all the errors 5 minutes ago.
Yep.
Looks great. Sweet. Cool. All right. Well, I think we have a good number of people in here already. So we'll get started. But yeah, just gonna give a quick intro and then pass it on to the organizing partners to say hello from everyone. But first off, I just want to thank all of our researchers. We're super excited to be here today, wrapping up a 3-month program of education and research with lectures and hacking and sharing and lots of collaboration. It's been an awesome 3 months spending it with everyone, and we're really excited to share the results and across a bunch of different token engineering and DeFi communities too. So welcome everyone. All right, so the agenda for today is quite simple. First, we have a hello from the organizers, and then we're going to jump right into presentations because that's why we're all here. And yeah, these are the 6 presentation topics in order. Have a quick look. It's going to be a fun about hour and 20 minutes, maybe running into hour and a half. And we'll have a lot of awesome content, time to ask questions after each presentation as well. So yeah, so then now we'll get right into the hello from the organizers, and I'll hand it off to Jakob to say hi from HydraDX.
Hello, everyone. Thank you for joining. I've seen a lot of interesting work, and I'm really excited about this. So I hope we can continue working together even after this is done. And I would like to say that we would love to give every participant of the token engineering course some reward pending treasury approval. And we will propose to some teams continuous funding of their research because we like what we see. So with that said, thank you everybody for going through this and making like a great deal of work and moving this research forward. And I'm just looking forward for the presentation, so I'll stop talking and give it to other guys. Thank you.
Cool. And now we'll jump over to Angela from TE Academy.
Yeah, hello, everyone. Hello, Jakob from HydraDX, Jamshid, Balin, Chris from BlockScience. I mean, I've met Kubo from Hydra, I think 1.5 years ago, when we just started with the token engineering community. And back then, he already told me, we need to strengthen this field of token engineering. I want to work with this community. And he kept his promise. So I'm really glad to have you guys as supporters of token engineering education and collaboration. And this research group program is basically how we try to come up with education and collaborative research in this new field, because token engineering is so new. It was first mentioned 3 years ago. So we pick up real crypto cases like HydraDX. We feel really blessed to be able to work with researchers at BlockScience to train people in the crypto community, in the token engineering community, supported also by TE Commons, our great commons for funding and managing funds for token engineering public goods. So to collaborate to progress this field, and I'm super excited to see the results today. I think we really have been lucky with the participants in this group. It was an exciting mix of people from various backgrounds, driven all by their very own motivation to further explore. And finally, I'd like to say thank you to you, Peter. Thanks for running this program facilitation. I think this is what really matters. So to be always the point of information, whatever it might be. And yeah, now looking forward to see your presentations, everyone.
Sweet, awesome, thank you, Angela. And then last but not least, we'll pass it to BlockScience. And I'm not sure who will go, either Chris or Jamshid. Would you like to jump up?
Or Barlin?
Or Barlin, if you, yes, Barlin's here.
Do you want to go,
Barlin?
Otherwise, I can.
Do you want me to go?
Yeah, go ahead.
Sure. Yeah, I think this has been really exciting to watch the progress and see the ideas coming forward, and see everyone kind of work towards those ideas. We certainly hope that it's been nice to see that like some of the methodology has been incorporated in that. So that was like one of our goals, and I think we've certainly seen that. So I'm looking forward to seeing the couldn't call it the end product, probably not the end product right now, but the end product for now. It's been exciting. So it's been a great group all around. So.
Cool. And I would give another huge thank you for all the support and question answering from the Hydra and BlockScience teams. There were so many questions in Discord and live in the meetings and stuff. So huge support team there. And Jamshid, I saw you unmute. Were you also going to jump in?
Nope, that was good.
Okay.
I was said everything good. Thanks.
Awesome. Very cool. So I think that means we, yes. So this is just a quick reminder to set the stage for everyone. This is not a competition, but there is a reward for everyone presenting today. This is marking the successful completion of the research program for our researchers, and they will all be rewarded with a POAP. And these POAPs are fun to collect, but they also might mean something one day. They might be the foundation for certification for token engineering. They signal that you've completed a course and you've mastered DeFi or mastered AMMs. So we're excited to be spreading that with these researchers, and also indicates TE Academy alumni. So after this course, we'll be awarding one of these to each of the researchers. And then before we jump into the presentations, I just wanted to mention for the audience that we will be doing questions. So the schedule is 10 minutes per presentation, and the last minute or two will be reserved for questions. So if you want to share your question in the chat or raise your hand, then we can facilitate the question asking, and we'll do first come, first serve. So be ready. All right, and then I believe we are on to the first presenter. So this one I'll hand off to Kirthi. And
thanks, Peter.
Yeah.
Not sure if I can start sharing my screen, but it does not allow me to.
There we go.
Thank you. Can you see the screen?
Yep.
Brilliant. So this research question was more to understand the impact of regulation on HydraDX OMNIPool. The premise, okay, so first, before I get into the premise to talk about the team, so it's just myself, but a big, shout out to everyone who's helped me, especially the BlockScience team and the guys at HydraDX, and of course, Dr. Lau, who's always been behind the structure of the research in itself. So thank you everyone for making this wholesome and with lots of interesting perspectives. The agenda is just a brief, so I'm going to go over the context, the use case, of course, the research questions and metrics, and to conclude with learning and next steps, which will follow. So today I'll be talking a bit about the context, which is to do with insurance-linked securities and what are these and how do these come into the context of HydraDX OMNIPool. Insurance-linked securities happen when there's a convergence of capital markets and insurance markets. So what that exactly means is think about someone who's a non-insurance company taking on your day-to-day risk of insuring a property, a vehicle, a factory, or even satellites. This happens today. So there are certain institutional customers who take on aggregated risk, which is also called as an insurance. So think about it as a group of insurance policies which are put together, and the risk is eventually passed on into reinsurance. And down that chain, you need some sort of a money to protect the users. So what happens is that institutional investors put their money in return for premium. And if there is a loss, there's a loss just like any other asset. But the interesting element of this asset is it does not show any correlation to your classic stock markets. It shows more correlation to human behavior, the climate, and other calamities. So all in all, these instruments are very lucrative for the institutional space. I decided to explore this use case further. I wanted to bring AMMs into the structure. And I will quickly talk about what I did in the past to come to the point of regulation eventually. So the basic context was I took this use case and I tried to do something in balancer simulations in the beginning. And when I started this research in balancer simulations, I wanted to understand if AMMs would be like a cost-efficient mechanism for trading these insurance-linked security assets. Why? Because today there is no functioning market for these assets. There's no secondary market. Most of the times it's peer-to-peer that is run through a broker discovers the market. And I thought like maybe AMMs would be a great solution to solve that institutional problem. And when we did this in the balancer system, we came up with a very unique model of centralization and decentralization of these assets. How would they work in the centralized institutional space versus a decentralized institution space? We got some very interesting results, which is not the scope of this discussion, but it adds a very interesting context to why we are going here. It tells us that there is great income, there is the capital is ring fenced, and it proves a lot of these interesting use cases which are included in the appendix of this presentation, so you can refer to it later. What we discovered as a part of balancer simulations was really good. We said AMMs offer great strategic value, and they provide like a fixed fee trading mechanism or automated making mechanism for these niche type of assets. But the trick was that it needed a lot of regulation. So the next steps which came out from the balancer simulation project was to go away and explore this further to see if we could have unique structures or architectural designs which could work really well with the AMM pool structure. And that's when HydraDX OMNIPools came in. And then I said, this is an interesting avenue to explore further. So now this is the juicy bit where all the good stuff happens. So what is the use case here? Yes, we're still solving the existential problem, which is to do with very high commission that is charged for these assets. But we've already proved in the balancer simulation activity that we are able to make it cost efficient, but our barrier today is regulating some of these assets so that our two key stakeholders in the institutional space, especially in the UK jurisdiction, is FCA, and in the Swiss jurisdiction, it's FINMA. And we wanted to go away with the hypothesis to say that regulatory mechanisms can be built around, the HydraDX pool to allow institutional investors to trade with confidence. So that was a basic hypothesis I tried to build on. The measures of success were to kind of implement certain models and mechanisms that make regulatory activities easier, a lot of transparency in the way we do things, and we are compliant by design. So it adds to these three basic requirements from the regulator. One is to do with financial stability, the other to do with interoperability, and third to do with operational resilience. If we are able to achieve these three factors, it would simply propel the solution into the institutional space where AMMs would become a day-to-day requirement, or perhaps the most sought after technology to use for liquidity provision for these niche type of assets. Now here I've listed some broad generic requirements which have been defined by the Financial Conduct Authority and FINMA. They're very, very generic in nature. This is not a very, very clear guidance. And this is where I felt that we could go and educate the regulator, exchange ideas, and that's something that we are currently doing today. What I've systematically tried to do in the next few steps is I'm just going to show you a quick evolution of the journey as to where what we have done, how we've validated some of these regulatory requirements, or at least built mechanisms which propel us to the next steps of the investigation. So we visualized the system as to what it would properly look like at a very high level, at input, process, and output level. We isolated systems to understand what it would look like in the whole big complex system of security tokens as insurance-linked securities. So you can see that in the entire asset lifecycle, AMM trading is one of the OTC, and AMM trading are one of the last two elements. This is where the general AMM dynamic system sits. And this is where you have certain functions, policies, etc., that we will try and deep dive into, and admissible actions, which are a basic component of the larger complex system. So what we are trying to do is we are trying to isolate a part of the AMM and try and see to influence it externally without changing the design of the AMM in itself, but influencing the factors or creating these specific barriers through which, or mechanisms through which we can influence the AMM to be regulatorily compliant. Now, how I've layered it down further is through various specific layers that would interact with the AMM's dynamic system. Through these layers could be in identity, oracles, operational resilience mechanisms, and compliance mechanisms. I'll talk about a little more of that in detail. I'm conscious of time, I'll move quickly. These are G parameters that I identified from the research. So if you look at the whole big dynamic systems, these are the policies which control the inputs into the systems. And we have been able to, at a high level, understand that there is a possibility to do identity, AML, and FATF compliance. So we've tried to build some generic flows to understand how that fits into the AMM pool itself and how that could possibly interact with this AMM pool. What we've been able to clarify by this mechanism is we've been able to clarify that we're successfully able to do these four things. We are able to conduct requirements. So this is as per the regulation. We are able to do clear notification and reporting. We are able to do record keeping as a part of this reg reporting decision-making process. And of course, we have some sort of a controls process that we've defined that would help us do the financial controls which are required in case there's a financial crime of some sort. Call it a circuit breaking mechanism. I'll move to the next, which are called as V parameters, or admissible actions into the dynamic system. So this is all based on the BlockScience definition of general dynamic systems. In this mechanism, we look at, again, enforcement. So it brought out a very interesting concept of two things: governance spots. That is, there's a possibility of having certain governance spots in the ecosystem which would help regulate specific actions. That is, regulatory intervention and operational resilience these are certain constructive mechanisms which help the regulator keep tabs or enforce certain requirements as and when needed for whatever reason or whatever trigger that happens within the industry. The last but not the least, I think this is more about operational resilience in the sense it shows about a decentralized NAV mechanism that we designed as an input into the AMM dynamic system. What this talks about is how oracles come together to report a NAV into the ILS primary pool. So this is a decentralized NAV structure, which kind of gives that transparency to the regulator to say the pricing is transparent for the assets, and we are able to report this real time without any latency, as in where the telemetry is present. Last but not the least, this is the actual design in which we talk about both the policies and the admissible actions interacting directly with the HydraDX OMNIPool system. We show how these actions can be controlled and regulated using different state variables and state update logics. And this is what creates the uniqueness to say we haven't touched the dynamic system in itself, but we have regulated it externally as a shell, as a series of controls and admissible actions, which need to be modeled in the future state. So that concludes my research, and these are some very interesting observations as a part of my research. We are able to show a lot of operational due diligence, resilience due to decentralized nature and the oracles for the outsourced system. So that gives the regulators a lot of confidence in the sources of data and how we are doing the net asset value reporting. There's a clear opportunity to do what is known as a semi-autonomous organization. In the absence of a DAO, this is some sort of a hybrid structure where there is manual intervention as well as centralized set of rules. So it becomes like some sort of an elastic hybrid model, which is still able to control these institutional assets which are represented by security tokens. There is a very, very strong possibility to model AML KYC controls as an external layer without directly impacting or changing the pool design. Circuit breaker mechanisms can be implemented. So there is a very clear state variable that we can define in the HydraDX system input state, which can prevent complete trading within the pool in itself. We are able to also do mandatory reporting and other possibilities very, very clearly at real time. There could also be there is an existential need. So we've discovered that there is a clear need for governance and enforcement bots, which need to be built as a part of the system model. So last but not the least, the conclusion is, while we are able to do a lot of things using external layers, the other discovery was the token architecture of the system is also an important element. So the choice of blockchain, the choice of token architecture is very, very critical in enforcing some of these controls we've identified and mechanisms we have identified. And I think the HydraDX AMM system can offer a great strategic advantage for security token. So I think there is a great potential to do this further and explore this further. So the next steps for me, because this is a long pending research which has come across 2 research cohorts, for me is to complete some element of system simulation in the next steps. Of course, there is a whole element of ongoing charge figure to figure out who pays for whitelisting, graylisting, and restriction of funds. How does that mechanism work in itself? And what is the cost of the actual cost comparison of managing ILS tokens or security tokens through an AMM versus the traditional way of doing it? And of course, last but not the least, MVP development, so minimum viable product development. Hopefully, we're able to look at those token architecture standards, which allow us to choose the right architecture, and integrating this into the bigger asset digitization project that I'm currently working with, which is called Project Athena. So that concludes my presentation. Thanks, everyone. I hope that wasn't too fast or.
All good. Thank you, Kirthi. That was great.
Cheers.
We can sneak in one question or comment if there is one from the audience. Otherwise, BlockScience or Hydra teams, if you have one, be great to hear.
Yeah, sure. Thank you, Kirti, for the presentation. I was wondering to which extent you've explored the differences between integrating a governance bot and integrating the governance structure into the system itself in your design, because these are two different approaches for probably the same cause. And I was wondering how you're trying to approach it.
I was thinking more of a governance bot to enforce certain rights which do not exist today because of the token architecture. In that case, we need a governance bot. But if in case we have the right token architecture, then we are able to design this within the system itself as a logic.
Yes, I see. So the governance bot would be as if it was an agent participating in the system.
Yes, but it would respond to regulators' enforcement rather than anyone else's enforcement.
Cool.
Awesome. And sorry, Dr. Lawrence, we only have time for one comment. We got to keep the train moving, but you know where to find Kirti. So be sure to follow up. But Kirti, again, thank you so much for the contribution and the presentation. Great to see it. And we hope the work continues too.
Thanks. Thanks, everyone.
Great. All right, now we're back to the cool title slides. And up next, we have Henrik with Institutionalizing DeFi. And Henrik, I'll let you share your screen.
Yeah, let me try. So can you see my screen?
Yep.
Okay, so this is something I'm doing. As some of you know, I'm currently trying to write a PhD on bridging the gaps between traditional finance and decentralized finance. So this is sort of an obsession. How can you institutionalize DeFi? Because its technology, of course, looks very appealing compared to how slow things move in the monopolistic traditional finance. The team is myself, and then for 3 weeks I've had support of a guy called Mark, a token engineer from a previous course, who has helped me on the coding. The research question is basically how would the economic parameters, specifically the price equilibrium, the reserve development, trade volume, slippage, develop in a replicated DeFi permissioned application versus permissionless. So basically using an AMM where one is whitelisted, suggesting that's for institutional trade use, and one is not whitelisted, so any kind of trade would be there. The sub-questions were very much, okay, how do you define the role of an arbitrageur? Because I think this came originally from Aave's CEO when they were launching Aave Pro, now called Aave Art, I think, over the summer. He was interviewed by the blog and suggested that the price discovery between the two pools would be equivalent because an arbitrageur would be able to participate in both pools. So one whitelisted arbitrageur would then be able to trade between the two pools, and the price would be basically arbitraged away. That's an assumption. So I would love to test that. And that's basically the whole project. So the assumptions around this was trying to use the Hydra. There was a Uniswap version 1 benchmark, but as we got into it, it was pretty difficult. Of course, Hydra itself was possible to be used here, but I'd like to basically make it as simple as possible. So it was more like, how do you have a simple trading pair, USDC versus ETH or USD versus ETH, and not a lot of complexity, trying then to simulate changing just one parameter at a time, and also ideally have real life data, real event trade data from both an institutional world and then a permissionless world, and then from the same time period, and basically try and simulate trades from what we see in real life. So Hydra being not yet launched was also a challenge there. So, and lastly, Mark, who helped me, he found it was pretty hard to do the Hydra setup. So we basically changed it to make a token spice agent-based simulation approach instead, and then combine it with a CatCat or RadCat, because the component architecture in RadCat actually showed to be pretty nice to have for parallel running of experiments and simulations. So there's a liquidity provider agent that earns money based on return requirements. So they will throw in money or liquidity if there's a bug to be made. And then there's a minting and burning policy similar to what's in Uniswap. One trading pair only, USDE versus ETH. The white pool is constrained by KYC. We're not actually providing a KYC modeling setup for the smart contract, just stipulating a policy that people who trade in this pool, the white pool, are KYC'd. 20 agents in the gray pool, 10 in the white pool, and 5 of them overlapping. So basically the agents that are trading in individual pools are swapping only, and then there's arbitrage activity between the agents that can do both pools, and then the liquidity providers will throw in liquidity or burn depending on their needs. And then trying to simulate all sorts of dimensions of this, and that actually then became seriously complicated with a lot of details, and each of them having wallets and their own wallets with different trading strategies and different everything. So basically trying to mimic a real world scenario. And trying to basically demystify the space between traditional finance and decentralized finance. Obviously, there's a lot of hype around DeFi, but a lot of traditional finance people, I don't know if they embrace the concept of DeFi or understand it fully, or so the idea here was actually for the purpose of my PhD as well, to have something to start communicating with. So here's a state map, basically 2 different pools, but an AMM setup where you are listed, whitelisted or not, KPIs with fees earned, trading volume, price discovery over time, and reserve development, and then trying to make experiments where basically it's a base case and we change only one parameter at a time, and then we try and compare. So the first one is, well, experiment 1 is a base case where you have 2 pools, basically somewhat similar sizes, but different prices. So here's the white pool has $20 million and 10,000 in ETH, and in the gray pool has 30 million in US and 14,000 in ETH. And then basically we set the bottom-up trading policies based on observable patterns. So for example, for the institutional trader, I looked at Coinbase Pro. I've only just received the data from Coinbase Pro last night, so this was more just looking at how it sort of trades. Seems to be, because there's no fee on Coinbase Pro, it trades a phenomenally small ticket prices, but at high frequency, so quite a lot of bot activity. And similar on Uniswap, watching their API, it's sort of like, well, maybe 2 trades a minute, but 10 times bigger ticket size than in institutional setting, which is actually completely opposite than what I would have thought. I would have thought institutional trading would be bigger tickets, but there you go. Basically then try and simulate how the reserves develop, how the price develops, how the fees are earned, and this is where just an examples of how the reserves develop. Basically, I thought that if you would start out, my assumption was, well, one of them will win, but actually they seem to reach equilibrium. I should also say there's a lot of bugs still in the whole setup. So we have the infrastructure is there, and the agent behavior is there, and the experiments are in the notebook, but there's actually still bugs in the reporting layer. So I've been struggling with that all day for this presentation. Experiment 2 was then, okay, let's make the white pool 10 times bigger. I would assume, okay, if the white pool goes 10 times bigger in volume, you can then have the same bigger ticket size trades with the same slippage. So therefore, that actually would be an appealing thing that would make the white pool win. But actually, what seems to be the case here is that if I make it 10 times bigger, it actually sort of over 3,600 time steps actually sort of evens out. It reaches a new equilibrium. It doesn't sort of kill the other pool. So maybe it's a bug, still to be determined, but it looks like that's the case. And then I had the next experiment was, okay, let's make it smaller, and then it crashed. So here we go, bug hunting every day, and probably for the next couple of weeks, being not an expert in Python, I'm on a steep learning curve, but it's really interesting. So experiment 4 to 8, I haven't done. They're in the notebook. Basically, okay, change the trade frequency in the gray pool to 10 times what it was. set the trading fee, reduce it to 0. What happens, basically, how the pools then develop to analyze the trading fee sensitivity. We also have a whale impact, an institutional whale enters and throws in 15 million US and 70,000 ETH. What happens? And then we also have a bug similar to flash crashes. So in Bitcoin, we have a trader who actually has a bugged algorithm. So he starts selling like hell between time step 100 and 1000. What happens with everybody else? How do they trade based on that? And slippage observations, basically setting slippage to 0 instead of 0.5 as it is default in Uniswap, and the number of agents, trade size, variable trade fees, etc., etc. It's basically, now I have a nice infrastructure I can play with a lot, and I can extend it to everything. So that's what I wanted with this, and it actually now works. So thank you, Mark, for helping me, and thank you all of you for actually teaching me how to get into this. So my lessons learned here is usually interesting, a very sharp learning curve for me. I would say even a simple AMM as Uniswap is not simple when you implement. All the things that you need to consider in agent-based simulation is really sort of, wow, okay, need to think of that, need to think of that. And I think I'm pretty sure the Hydra setup and the Cat can deal with the agents in the same way. I think Balin showed it last week, how it could be done, but I think it has helped me a lot to basically take each of the agents and their policies and trading policies and say, this is how they are. And then I can use the components, I can basically extend them, I can shape them in different ways. It's easier to articulate multi-dimensional trading behavior and improve basically the composability of the setup rather than running bulk behaviors from many different agents. And I think also lessons learned, articulate the requirements, the experiment requirements up front. Scope creep also exists, even if you think you know what you're doing here in this space. I can just see things have just, oh, but I need that and I need that. So it's really hard if you don't know where you're going, but it is actually a good exercise to think the whole exercise through before you start. And also, as of today, I need a bigger laptop. And as Rudy already said, forget about Windows, throw it out, run on Linux, or as a minimum a Mac. And I've now partitioned my hard disk on my Windows, and I have an Ubuntu setup, but still the performance is problematic with just a traditional laptop. Further work, tons of things, fine-tune the experiments, debug, finalize plot functions, incorporate more token pairs. I'd love to have a Markovich portfolio optimization arbitrageur, basically optimizing between liquidity provision and trading and swapping. Love to see also external oracles or price indicators, so signals for trade. Try and incorporate the Hydra, the balancer, the integral, Uniswap, whatever, many new things come around. And then of course, try and change the trading pattern to be more realistic based on the data I now have from the institutional side. And I hope Jakub from Hydra will also supply the Uniswap data that we talked about last week that he might be able to get. Then potentially expand the ecosystem to also include a lending and borrowing protocol and add some derivatives. And then of course, ideally, I'd love, coming from a finance and regulatory background, if I could do embedded supervision and figure out what is it actually a supervisor needs for monitoring behaviors and risks in this DeFi setup, and why would we not then want to automate the supervisor as well by basically embedding the data required and then setting up the smart contracts in a way that would help. So I hope I have a now flexible setup that can be built upon in true composable fashion. So that's about it. And hopefully it'll lead to a research paper or two at some super fantastic conference somewhere in a nice Caribbean country or something. Thank you.
Awesome.
Henrik.
Thank you so much, Henrik. Yeah, mentioning scope creep, and then there's a list this long and your next steps.
Yeah.
Yeah, and I also have to recognize Henrik for diving into the deep end. He was faced with quite a steep learning curve, and he always mentioned it, but he kept climbing, and that was, I really admired that. So had a lot of support too, but awesome to see. Cool, we have time for one question for Henrik too. Or if it's a comment from BlockScience and Hydra.
I don't know if that's good
All
or
right.
bad.
They're all focused on your next steps.
It was all good. So we were happy to read through this and give feedback afterwards.
Thank you.
Cool. Well, thank you, Henrik. Awesome work. And we're back to the title slides. Next up is Andy, Invent and Chill, and he is presenting on stress testing of OMNIPool model, toxic asset problem, and potential solutions. So Andy, I'll let you share away. Andy, are you there?
Yep, moment, please.
All right, we've got your link. And I also have your slides too, if it would help to share them. Got
Hi,
it.
friends. Do you listen to me? Do you see my slides? All okay?
Yes, all set.
Yes, my presentation will be about stress testing of OMNIPool model, toxic asset problem, potential solutions. Well, I sent you a link. It's a link to model. You can open it to see, just to check something during my presentation and ask some question. So first I want to say that I prepared some kind of data. It's a tick data for 2 to 3 months for several cryptocurrency tickers, including DOT and KSM, and all data available in Pandas data frame format. Second one, I get all all big formulas from CAD representation of OMNIPool model and created some kind of more traditional one, which is very good correspond to OMNIPool white paper we have access to. So it's quite easy to just to compare it code and white paper. So as I modified a bit OMNIPool CAD model and introduce a tracing print into each part of model, and it's very useful for understanding and checking of models. So each calculation was doubled with digital representation. Here is an example of risk asset for risk asset swap with parameter of model A equal to 1 and the amount of liquidity we needed to pull to risk asset I as 7777. So here, for example, we can see that we did to I7777 and we get from pool another amount of G token, and here is calculation including new prices, for example, here and here. So for deep understanding of OMNIPool mechanics, it was decided to create smart model. Smart is a free analog of SmartCAD. Maybe anyone of you know about it. It's a quite old system. So it's a program with a central interface, is an interactive notebook in which equations and expressions are created and manipulated in the same graphical format in which they are presented. Everything available on the desktop and web version. So you can easily change any variable and other variables, and will change immediately in Excel. So it's extremely useful because model implementations is the same form as an OMNIPool white paper. In addition to CAD model, several features like a slippage calculation were implemented. An example provided for R-to-R swap with parameter A equal to 1 and delta equal to 777, and results are same as from CAD model, and you can check the result, the tracing before. So here is example how it works. You can check it with your link. For example, here we're changing parameter A and everything's changed. So here is a different parts of model, different calculations, slippage, delta, and others. So for example, we can compare that here we get a new, we have a get amount of token we receive from pool in exchange, and here we see the same digits, so everything works fine. So I tested it for different samples, all okay. I made a sensitivity analysis of parameter A. It's a parameter you can see everywhere in model, here for almost all formulas, and tried to move it from 185 to 1.05. Here is the results, and here is difference between any type of test with A is not equal to 1 and the test with A equal to 1. We can make some kind of conclusions based on sensitivity analysis. For increasing K, we have increasing Y, decreasing Y. For increasing A, we have decreasing absolute value of delta RG. It's the amount of token we receive in exchange of token I ready to pool. And for some point near to A more than 1, we start get less G token than E token, I token we send to pool. We can see it here. So some point it's start to be less than 77777. For A equal to 1, initial token prices are equal. For A more than 1, initial price of E more than G, and for A less than 1, initial price of E more than price of G. It's also can confirm here. So for slippage, for all A, OMNIPool slippage is higher than Uniswap slippage, twice higher on average. So we can see it here. So for example, and for more A, we get less slippage in OMNIPool. Maybe because of price differences. Yes, so I also made the test for extreme conditions. We make two scenarios. First one is asset I became toxic asset, and market participants want to sell it for G. Size is equal to 100 of I in the pool. A is equal to 1. Let's say test 6. And second one is that I completely lose value and market participants want to sell it for G. Size is equal to 1000 of I in the pool, so test 7. We can make several conclusions based on stress tests. For increasing delta I amount of token we added to pool, we get increasing OMNIPool delta RG, and max level expected around to 500,000 by 50% of G in pool. For Uniswap, max amount of token we receive is closer to minus 1 million, 100% of G in pool, so we can see it here. Slippage is higher for OMNIPool model, dramatic prices changes, so you can see it here. In case if assets I lose value, it's still possible for market participants to remove value from pool in short time by selling a huge amount of assets. So we need fee mechanism for stopping drawing of value from pool in case of market distress. So for potential way to resolve toxic asset problem using volatility dependent fee, its OMNIPool model will contain a lot of different assets. If one of these assets will become toxic, market participants will start to sell this asset in exchange for assets with value. If we will not stop this process using some type of triggers or dynamic fee changing, market participants will add to pool toxic assets with no value and will receive good assets in exchanging. Result will be draining value from pool and losing funds for liquidity providers. Developed solutions should satisfy several requirements. It should not be computational intensive because every calculation on blockchain costs a lot of funds. It should have good reaction in case of price decreasing and potential toxic assets. and it's better to use only on-chain data. One of potential fee implementations to the denominator for amount of token we receive. As an example, amount of token trader receive. As an example, we can say that the amount of fees should dramatically increase in case of relative price decrease more around 20%. In QQ is HDX token in pool. Price can be determined as a pool price specified amount of block ago versus price in current or previous block. And the denominator can be selected as like this formula. So digits can be different, so just an example. So here is the results, and it confirms that for small price movements, there is not a lot of difference in token received with fee or not. So in normal conditions, it's work as before. But if price decreasing a lot, so the denominator achieve around 14, and token received dramatically decreasing. So here is a table for different negative price changes and behavior of model. So here is a chart of function. And this formula can be changed a bit if it would be needed. It makes more sensitive to several time periods with different sensitivity. Model can be easily changed. There is some example for 2 periods and new parameters. So something like this. Also, we can add a fees that will decrease amount of token we receive for RI with trade size relative to pool size without reliance of price movements. It's another option what we can do. For future development, maybe it makes sense to make similar models for Q2R, R2Q, and liquidity USDO. It's the parameters of R is the risk assets, Q amount of HDX native token of OMNIPool, which is very useful for model understanding and huge time saving for new researchers. So if anybody want to jump in OMNIPool research, he can use this model and spend around several days and to understand how does it work. So it'll be good to update model to new specification of OMNIPool. Last available was version number 2. Tests for potential vulnerabilities of model and finding new ways to improvement, testing of new fee mechanisms, cut OMNIPool modification and development, getting feedback from team, and taking part in the development of incentivized trading game with involvement of people, which I know is expected to be in the future, and more duration. Thank you, friends.
Awesome. Thank you,
Any
Andy.
questions? Happy to answer.
Yeah, I want to give Andy props for diving in extremely deep to the OMNIPool model, as you can tell.
This is really, really helpful, and we were thinking about this, and this part of research, I think, is one that we can try to use if and continue. I really like this one. It's great. Thank you.
Thanks. First aid.
Yeah, I'm gonna have to look into this this math. You said it's an open source math CAD thing, the test math thing too.
And Rudy, you have a question?
Yes, just a short question. For simulating the influence of fees or calculating it down, have you considered the impact of different trading behavior? Because if the fees are high, I'm quite sure the trading behavior is different from a market with low fees.
Well, particularly, yes. Its main idea was assumptions that when you have some kind of token in pool which losing their value, the behavior of traders is the same as to sell as much token as you can into this pool. So it's more about to check that pool will be alive after this action and how to do it. Some kind of mechanics to mitigate the huge amount of losses of it. So because for HydraPool it's a bit different than for example, like OMNIPool. In OMNIPool, it's only 2 assets, and if one pool is broken, okay, only people who are getting these assets are just losing. But for OMNIPool, it's a lot of different assets, and if one of them become toxic, and everybody will sell these assets for all other, which is not, it will be not okay. So it's
snakes can bite.
Yeah.
Thanks.
Awesome. Any last question for Andy? Inventing and chilling through the whole course. Awesome work, Andy. Great to see the final product. All right, and next, of course, the cool title slides. Next up is Rudy, and he's going to be talking about identifying arbitrage signals. So Rudy, I will hand the floor over to you. All set? You're muted though. There you go.
Yes, so I said, let's jump into the topic. We will take a small step backwards and take a look at the fundamentals. Coming from physics, I've learned one thing: handle your observables as if they were children with loaded guns. I will take a look at how the price alignment might be related to different observables and what observables are sufficiently well defined so that we can grab information from that. I think reading outline and title is relatively easily. We can directly jump into it. What is arbitrage? So let's take a more detailed look at it. We know that it's about price differences, and usually arbitrageurs can make quite a lot of profit from that. This profit is related to impermanent loss, which is a quite bad thing that we want to reduce. It is also related to volatility for 2 things. First, impermanent loss itself is a special case of volatility, I would argue. And the relation to price differences and price alignment directly relates arbitrage to volatility. From my point of view, we have to deal with highly nonlinear oscillating systems. And if it were not for arbitrage, all the AMMs would not be coupled in any way, and we could just look at a single AMM and ignore everything else. But arbitrage is what couples a single AMM to the wider market. So we need to understand what exactly is arbitrage and how does it relate to the market internal structure. On the right-hand side, you see a diagram that shows this process of arbitrage and price finding. If we take a look at marketplace 1, some Bitcoin is entered, swapped into Ethereum, and the market gives out this Ethereum. The market comes with a specific price. So the amount of Ethereum you get for the given Bitcoin is controlled by this price function. Here I've written it as the P with a lower and upper index. Now, after the swap, we take this Ethereum and just walk to another marketplace that maybe gives us a better price or not, and swap back to Bitcoin. From a mathematical point of view, the whole procedure can be collected into a single one by multiplication of the 2 respective price functions. And if this multiplied price function is larger than 1, the arbitrageur can make profit from this swap. And he will do so until the prices are aligned. So the criteria for vanishing arbitrage opportunity is that the product of the prices has to become equal to 1. So this is arbitrage. Now let's take a look at what are arbitrage signals. Any hint at ongoing arbitrage. We are not interested in predicting prices. We are not doing any voodoo here. We just want to know if the prices are changing. We're not questioning the direction, just if they are changing. To do so, we will look at correlations. That is correlations of prices, price changes, or the spread of prices. That is the different prices for different markets at the same time. I assume the following properties for such arbitrage signal. That is, we know that arbitrage is a kind of self-correcting process. That is, if there is an arbitrage opportunity, its existence will be the cause for arbitrage trades that make the opportunity vanish. So any arbitrage signal should correlate negatively to its own change. So we have a kind of oscillation equation there. Now, what have I done? I collected some data from coin ranking, specific the price and volume of trading pairs. The statistic was not very good, so I collected only 3 days in intervals of 10 minutes and have quite a lot of holes within this data due to internet connection losses. But the data is well enough so that I came to final conclusion that allowed me to test this hypothesis, which will be in the next talk presented. The specific observables I looked at is the average price with an equally weighted price over the different markets, the volume weighted price, the volume itself, the standard deviation of the different prices, and a lot of further observables. Important is I look at the absolute of the change of the price, because this is the most prominent arbitrage signal, but also these two standard deviations, the lower one is calculated with the jackknife on deletion method, I quite direct arbitrage signal. What exactly have I done? I just calculated the correlations, or to make more correct, I made an G-square test for different hypotheses of correlation and checked the probability for the correlations from minus 0.95 to plus 0.95. Now let us look at the non-vanishing signals I attained. First, we see that a change in the spread of the volume indicates a price change. It's a quite trivial thing, but as long as it's not proven, it's an unsafe observable. Here we see, we can take it for given. Also, a change in the spread of the volume indicates the presence of price spreads. That's an important thing because here volume changes are quite directly linked to price changes. Now, the next thing, we have this self-correcting thing, the changes correlate. So if two observables correlate, then we can expect that the changes of them also correlate. We do observe this for the price and the volume standard deviation, and volume itself correlates to the price. The next thing, check if this self-correcting is given. As we can see, we have this negative correlation. The blue points are the probability for the respective correlation, and the green line is the average given with the standard deviation. The next thing, also the prices are self-correcting. Well, could have expected that. Now to the conclusion. What I have quite clearly seen is that the volume and changes in volume correlates to changes in price. This allows now for 3 different further approaches. The first is trading bots, because they are the most easy implemented, and we can just take a running AMM simulation and add this trading bot and see if it works out. The next and more complex thing is a dynamic fee mechanism. This needs to be implemented within the AMM. So here we have to look at the invariant and all the math behind it. The most promising approach may be a more general invariant that's taking into account not only the supplies of the specific assets within the AMM, but also the changes of these supplies. I would call it an approach based on supply accelerations and supply velocities, and it has some similarity with the Helm-Hamilton formalism of physics. So with this, I've come to an end, and it's time for questions.
Awesome. Thank you, Rudy. That was great. I would also have to add that Rudy was, or well, to back up a little bit, one of our the most exciting parts of these programs is getting to cross different different areas of expertise and disciplines. And Rudy did a great job of helping us understand some of his applications from his physics background. So we had a lot of really exciting conversations about this too, applying physics to AMMs and DeFi. So thank you for that, Rudy. And we have a question from Henrik.
Yeah, Rudy, how did you end up dealing with the wash trading discussion we had some weeks ago?
Yes, a colleague of mine is interested in doing a master thesis on the whole thing. Here at my data, I just saw that the signals I get are strong enough, and I had two possibilities: either improve the statistic and check if the signals hold, which was too complicated to do the wash trading. I do not know how to identify this from my data. The other approach, well, just simulated. I have spontaneously created a small Hydra twin in Mathematica, Wolfram Mathematica, and put up some simulations that validate my signals, so that I can see the same thing coming from two different approaches. This might be even more stable and more secure than just collecting more statistics.
Okay. Thanks.
And any other questions for Rudy?
Do the signals that you get for arbitrage include the direction that arbitrage?
I have also checked of the correlations to the direction of price change. Interestingly, I found some, but I have not shown it because it's quite obvious that it's dependent on the market phase. So I'm quite sure that if I would have collected more statistical data, then every information about the direction of the price change would vanish. But it may be present in the data. One could also use it AMM internally, but I'd be very careful with that because every correlation concerning a price direction is unsecure with respect to its sign. So it could always exactly the opposite be the case.
All right, we have time for one more comment if anyone is sitting on one. Otherwise, we can wrap up. Awesome. Thank you, Rudy.
You're welcome.
And yeah, I'll introduce Joe's next. He will be discussing bots, potentially the next step in the evolution of AMMs. So Joe's, I'll hand it over to you.
Can I start sharing screen? 1 minute.
Yep.
Okay, is my screen visible?
Not yet.
1 minute. Hang on.
The suspense.
I don't have the physically trouble.
Not yet.
You could throw in the actual link to a presentation and then I could share it if you want.
No, 1 minute. No,
Yeah.
no.
I also have it as well.
Yeah. Hang on, please. Give me a little bit of time.
Okay.
Got to go to Zoom and share screen.
There we go. It's
You
loading.
can see? You can see the screen?
Yep, just got it.
Yes, sir.
Okay, but just hang on.
All right.
Okay. I'll start now. Okay.
Yeah.
Okay, fine. Yeah. So basically, unlike the last presentations, mine will not be so quanty. It won't be totally, devoid of it. But token engineering being a multidisciplinary endeavor, probably it's good to see the other side too. Okay, so mean, it's called bots. The next step in the evolution of AMMs is basically a preliminary investigation. So this exposition is divided into 3 parts. First, highlighting the need for an AMM to also stress on market efficiency on top of features which all new enterprises actually will focus on. I mean, the second, a CAD-CAD based experiment simulating a market efficiency improving intervention implemented in Mathematica. Third, we give a possible technology trajectory for the evolutions of AMMs and the role of bots. See, basically, there are some fundamental weaknesses about AMMs. The need for external reference markets, AMMs cannot stand alone. The need for continuous arbitrage drains the liquidity of AMMs. Everybody here, knows that. AMMs are fundamentally weighted against large transactions. Impermanent loss and slippage are part of the system. So basically, our questions are: can an external agent like bots address these weaknesses for a specific AMM? Because these are internal to the system, and you probably need to go out of the system to tackle something like this. Can AMMs also be disaggregated the way AMMs disaggregated some of the allocated roles of centralized exchanges? What larger role can bots play in the context of the AMM ecosystem? And this particular research basically consists of Rudy and me, Jose Anthony, and the research question is a simulation of a volatility suppressing strategy to bring in market efficiency. This is based on our findings that a reduction of volatility reduces impermanent loss. We've derived an analytical proof on it. The second one, second one is that markets or AMMs will align to the most efficient one in ecosystems approximating which are general equilibrium. We have an intuitive proof for it, and the research proposition is an action which a bot or an agent could execute. And the key metrics are, a reduction in volatility and a reduction in impermanent loss. The idea is, anyway, this model was developed in Mathematica by a collaborator, Rudy Godovich. You just heard his presentation, his capability and capacity. It basically, simulates prices, identifies arbitrage opportunities and arbitrage trades. It simulates arbitrage trades. This is an initial model, but the results are indicative enough. He will take on any questions regarding it at the end of this presentation on the technical aspects of it. But basically, I will show you the results which he has come out with. These are the performance results based on no volatility suppressing action. And these are with volatility suppressing action. Going into a little more detail, basically what we see is that with volatility suppressing action, there's a reduction in impermanent loss. We infer from the reduction in arbitrage profits. And there's also a minor reduction in volatility we observe from the amplitude reduction in the pool and liquidator value. But there are many ways of increasing the success of bot actions. We see because this is only a test to see that it is possible to intervene into the markets. Like one particular way is by operating in the high probability areas as indicated in the above mean reversal chart. Derivatives like straddles, gamma squeeze, and giving path direction to fees and curvature. Okay, we can discuss this. In general, it will be the bots which will be executing the actions and not the protocol. But bots have a much larger role to play. Disaggregated purposeful bots can be valid extensions to AMMs. Imagine a swarm of competing bots incentivized through tokenization, aiding large order routing, which is a fundamental weakness of AMMs, and even into centralized exchanges, harmonizing between AMMs and And substituting for impermanent loss, subsidization, a core strategy of HydraDX. This, according to me, could be the first step in the disaggregation of the AM model in the true spirit of, decentralization. Remember, in one sense, AMMs also have disaggregated it. I mean, to a certain extent, compared to centralized exchanges, as I mentioned before. So now comes to my core proposition. Can AMMs disrupt markets completely? And we refer to the research study beyond money, cryptocurrencies, machine-mediated transactions, and high-frequency thing I'm bartering. I really highlight it because it's such a fundamental observation, but I don't think it's been given so much prominence. The inference we draw is anything which can be tokenized can be valued through high-frequency, infinitesimally small swaps of tokens, setting the value for every tokenizable object. In normal economic, so if you look at hyper barter based barter versus money exchanges, in normal exchanges, market clearing prices intermediate between humans, human 1, human 2. In a crypto economic hyper barter exchange, bots or agents will intermediate between digital asset matrices. So you have a bot in B, you have a bot there, like everybody will be. We expect will be interacting with the bot. Now I come to the end of markets, a technological trajectory. How do markets end, and what would be the way it could possibly happen? First, recomposition. Every function with an AMM could be recomposed based on self-standing functionality and self-sovereign identity. And recent Horowitz is of the opinion every API can emerge to be a standalone. Disaggregation, some of these could be disaggregated into external bots, partly based on circularity, and which could give rise to continuous compounding of returns in circular systems, making these systems ipso facto, self-sustaining. Ubiquitous high frequency, value realization. Anything of value can be tokenized. Anything tokenized will be valued using bot-based, AMMs. My old books and expensive bike, which I want to dispose of, could be tokenized. And end of markets, return of the ultra efficient barter systems. No need for an intermediate currency. I could probably buy the new iPhone by swapping what I don't need. My expensive cycle and my old iPhone and some books. Theoretically, the bots could take care of it automatically, swapping tokens across bots, and delivered by drones probably. So what does it mean? Essentially, up till now, money could buy commodities and commodities could buy money. But it's AMMs which allow for commodities to buy commodities. Every tokenizable object could realize their true value in this particular process. So what is the recommendation in as far as HydraDX is concerned? Because I set myself strategy that I will actually recommend things which can put HydraDX at the forefront. HydraDX could also look at market efficiency in addition to the new features it's looking at. It could look at promoting a bot ecosystem slowly, even a bot protocol, and investigate the possibility of bot-based functionality. It could begin looking at the medium to long-term opportunity for high-frequency based barter systems with its AMMs venturing into the pivotal role of ubiquitous valuation using bots. And that is my presentation. I think I've given enough time for questions, and you could ask questions of me and also Rudy in as far as the model is concerned.
All right, awesome work, Jose. Thank you. And we do have some time for questions, if anybody would like to jump in.
This is really interesting, Jose. I don't know if you know of Sunny Agarwal. He works in the Cosmos ecosystem. He works on Osmosis, which is, I think, a very similar project to HydraDX, building an AMM chain in Cosmos. And I've seen him talk about some of the same stuff you're talking about in terms of sort of the end of money commodity exchange and the role that crypto and AMMs. There's a lecture that I don't have the link handy for, but if I find it, I'll send it to you. But Sunny Agarwal, who works on osmosis, has very similar kind of ideas slash research.
Actually, I haven't heard of Sunny. I mean, actually, my primary interest actually came out of this because, I was interested in local level circular economies, and local level, circular economies are actually taking off with community currencies and a lot of tokens and all that. The beauty of it is that each of these, what I call, local level circular can act like a semi-closed system. So, we don't have to do it at the national level or international level of this thing. So it's possible to test it at that particular level, and its ramifications are really fantastic.
Great. And Dr. Lawrence, we can have a quick question from you.
My question is that who takes responsibility for these bots? Because if you have one which is like badly programmed, it can very easily turn into a worm, and then you can get cascading flash market collapses type thing. So it's nice to talk about the theory of bots, but at the end of the day, from a pragmatic point of view, if a bot goes haywire, who takes responsibility?
Yeah, it'll be the same thing as, a smart contract. Who takes responsibility for a smart contract?
All right. We don't know yet. Great. Well, thank you for that presentation, Jose. And I will take over the screen share to show the title for our final presentation from Paulina and team from teaming up also with Taz and Austin to cover dynamic AMM fees to reduce impermanent loss. And Paulina, I'll hand it over to you.
Thank you. I'm gonna try and share my screen. I believe, I see Austin is also in the call. I don't know about Taz. But yeah, this is a joint effort, even though I am presenting now some of our results. Give me a second. Can you see my screen?
Yep, all set.
Okay, cool. So I will talk a little bit about static and dynamic fees in order to deal with the effects of impermanent loss in a pool such as the HydraDX OMNIPool today. And I think, the main focus of these fees is, as we've talked about before, impermanent loss, or how we want to deal with it from the liquidity provider's side. Our team, is the three of us. Austin and Taz have been a massive help over the last 3 weeks in terms of coding, and I think also in terms of really getting to grips with what we actually need to think about when we model fees and how they need to fit into the whole ecosystem. And yes, so what's the use case? Well, the AMM in a liquidity pool can set certain invariants, and I believe most AMMs kind of try to have the liquidity pool have some stability by making sure that assets will not be drained or will not be drained to zero in the pool, and therefore allow for traders to trade all different kinds of assets with each other. But this comes with another problem, because that's not the only invariant that we need to actually care about. We also want to care about price stability and the effect of arbitrage. And so the problem is that with many trades, there just happens to be an arbitrage profit, wanted or not, and this would potentially drain some value from the pool and produce the effect of impermanent loss. And so what have we thought about? We thought about adding a fee to the trading behavior in a way that this arbitrage profit, which you can see here on the right, is kind of circulating and making its way back in full form or weighted back into the pool, such that the effects of impermanent loss are not felt for the liquidity providers that harshly, but also as a means to discourage trading behavior that is linked to arbitrage to some extent as well. How have we then looked at it? Well, we wanted to compare the effects of dynamic fee mechanisms in terms of the value that can be basically retained in the pool, but as well also in terms of trading or deterring business as usual traders. And on another note, we could say, like, is there a way to have arbitrage profit be reaped in its full capacity as fee revenue back in the pool, and how would that work? And the metric that our team has used for this is not impermanent loss per se, but the arbitrage wedge, which is simply a way of comparing two different kinds of real value. So if we think about an oracle from an external market, oracle prices for all different kinds of assets that are in the pool, we can now get two quantities. We can now get two real values of the pool. The first one is the one where we, so in this calculation, it's the total V1T, which is the value of the pool at any given point in time, denominated or like in external market prices, oracle prices. And the other one for comparison, which so far I've always talked about share value, but it actually is the value of all the liquidity and all the assets that have been provided without trading at external market prices at any given point in time. So that means how valuable are all the assets had we not changed their quantities through trade in the pool at external market prices at time t. And we've moved on and tried to simulate three different kinds of scenarios. The first baseline scenario is one where we add different price oracles for the external market prices into the CAT model to test out how these different ways of modeling external prices will actually affect our metric, the arbitrage wedge, and get a kind of feel for how the metric is behaving itself. So here we've used a constant function and mainly also a random stochastic function to compare with each other. In a second kind of sweep or version of this model, we then wanted to include static fees into the model. How have we done that? We have defined some sort of fee function, g of a equals a, where we said, okay, let's have a static fee be 1%, 2%, or 5% of every quantity traded. So then we would have a new quantity that is then implemented and put into the AMM, which kind of subtracts this fee percentage, and we would have a fee revenue that we add to a fee basket here defined as the total fee revenue, and is in the pool, but is kind of separate to the other assets that are still in the pool. And lastly, and most interestingly probably, was us looking at dynamic fees. Here we tried to work around dynamic fees with like two different indications. And I think here the work of Rudi is really interesting because we've taken kind of heuristic indicators for arbitrage that we haven't actually tested whether they are valid enough or like how much they should be valued when we define fees. What we've done here is first of all say, okay, well, we can look at a dynamic fee that always calculates the distance in price, external market price, and local pool internal price of an asset, and then weights the static fee with this distance in some way. This is a very simple weighting, but it could be any other weighting as well, obviously. And the second way, and that's kind of hinging at the kind of graphic that I showed you in the beginning, is actually take this arbitrage wedge metric, simplify it a little bit, and just say it is the overall difference between the pool value at market prices and the liquidity, initial liquidity asset at market prices, and have that be a weight for a fee. And that would mean that we would somewhat closely maybe mirror the arbitrage profit that would be made had we already done that transaction in the pool. So this is why there's a T+1, because it's calculating based on the quantity that is inputted, what would be the profit, and then have that be pushed into a fee. And we have simulated, and Austin has produced many different plots for us, which is still a little bit hard to get to wrap our heads around, but I'm just going to show you a few and maybe we can have a look together. So here are some preliminary results. Well, what I can say is that we can definitely see some sort of change in the arbitrage wedge, which seems to be increasing as we increase static fees, and it seems to be also increasing as we input dynamic fees. How exactly that happens and what determines the shape of it, we have not yet looked at statistically, and it's mainly like a graphical analysis at this point. Just the example output, it's all very small, but all the plots can be found in our HackMD. We've done different plots of both impermanent loss for the two assets that are being swapped, of the prices that we have simulated, and then the arbitrage wedge, and it's also the two metrics that define the arbitrage wedge. And the three plots on the right show the arbitrage wedge with a static fee of 1%, a static fee of 5%, and then the dynamic fee as we've defined it in the first version, the difference in prices. And then lastly, I think basically what I've been saying before, I think there is a very exciting possibility that dynamic fees can selectively extract the arbitrage profit, meaning they can target the actual trades that are based on arbitrage and leave out maybe the business as usual trades. And there's also a way to maybe extract exactly the profit that would have been made based on that trade, especially with a dynamic fee #2. Yet I think it's really hard to come to terms with it, or to make sense of it just on a graphical analysis in the model. And my personal learning, I think, is that the more you actually tinker with the model, the more scenarios you plot, the better you get to know how the graphs actually behave. It's not just looking at a single graph, it's actually looking at a host of different scenarios and a host of different trading behaviors to really get to know what this mechanism actually means. And we haven't done that properly yet, I guess, to come to clear conclusions. Yet I think future CAD/CAD models could do that, both in terms of trading behavior, in terms of different fee structures, different metrics. And yeah, I'm really excited to see, especially also how this fee would interact with a bot, an arbitrage bot, because I think that's when we really see whether it actually works and whether it can help decrease arbitrage in the liquidity pool. That's me. I think it's worthwhile to check out a HackMD because I have tried to make this presentation very sparse. Yes, thank you so much. And big shout out to Austin and Taz.
Awesome, very cool, Paulina. And yeah, as Paulina mentioned, the links on her last slide are in the document that Angela shared in the chat too. So great, very cool presentation. Any questions for Paulina?
Thank you for this. This is really good. I see a lot of synergies here already between the projects. So it would be cool to see how this work continues. I hope we'll find something, because this is really interesting.
Thank you.
Jakob, we are open to any proposals. And I guess everyone, it's generally a topic for, okay, people in the research group are creating great work. Some of them are able to continue, some not because of bandwidth. And I realized that you, at the beginning of this presentations, you already mentioned you want to give something back. However, this will look like, I guess we keep everyone posted. And of course, I'd be glad to see, matchmaking between the group here contributing value already and then future Hydra activities.
Awesome.
And along those lines, so I just want to let folks know, and I'll mention this in the Discord too. Last night I checked in sort of an updated HydraDX implementation. It's very bare bones into that public repo. And so I'm sort of hoping that that public repository, along with its discussions, there's a GitHub discussion section that I sort of intend to make the research forum in the near future here that we've opened up. So we're really happy with all the great work that's been done, and I'm hoping to kind of make that a place to continue our engagement. And I'm personally hoping to have more time to engage with kind of people than I have over the past few months. And I think doing it there will be kind of good for us. So what I checked in last night is like a restructuring a little bit. So it's a little different than the structure of CAD that you've sort of seen. But it has, I'll be basically doing my research in that repository. And posting things like just open research questions that are kind of questions I have to the discussion.
I think, I'm not sure if it was just me, some of the sound was missing, but Colin, please make sure to drop the link to the chat and to the Discord of the repository you mentioned. Thank you.
Yeah, that would be great. Thanks for the update, Colin.
Anyway, I would really like to thank, everybody, both, BlockScience, HydraDX, and everybody out here. This has been a fantastic program.
Great. Thank you, Joes. We appreciate it. All the hard work.
Yeah.
Yeah, and I've really appreciated how much I've learned from all of you too. Like I'm fairly new in the space, and I've just learned a tremendous amount every time anyone's presented on anything, or even when people are asking questions. So I've enjoyed that.
All right, we're doing thank yous, so I'll put up this this thank you slide. Lovely thank you slide. Yeah, and I also, for me, I've really appreciated the opportunity to participate with all the researchers and learned a lot from Hydra and BlockScience too. I also wanted to just drop the link again, even though it's just a few messages up from Angela, but all of these projects have their HackMDs, project slides, repositories, the work that they've done linked here. So if anything looked interesting, you can jump in there and read more, or contact the researchers on the side too, and discuss maybe bringing it into that research forum Colin was talking about. So certainly opportunities to move forward with this stuff. Very cool. And Henrik,
yeah, quick question. So I was just, while we were talking, went through the HackMDs, which are really nice, but the models, are they loaded up on a GitHub somewhere, or I know I loaded up my model, but that would be really nice. Second, to Colin, does that mean I can chase you when I can't figure out how to do a simulation properly?
Yeah, by all means, post to that forum. And I think, time permitting, we will answer in the forum. And I think what we'd like is for it to be a lot of peer-to-peer stuff, right? Everything's got to be kind of time permitting, right? It's an early startup and we're all crazy busy, as you can imagine. But yeah, I definitely would like to be helping people with CAD stuff. And I think if we use that forum sort of on the GitHub page as the center for those kinds of questions, or a center for those kinds of questions, I think we'll get the most, we'll get everyone who's kind of looking at similar types of models, and you're most likely to get your question answered pretty quickly, right? Because, for example, something that I think we'll definitely look into is what you've been doing with CAD and token spice. It makes sense to bring that more sophisticated agent modeling into CAD. And so I'm sure that we'll have, I haven't really looked at that yet, but I'm sure we'll be exploring that probably on that kind of HydraDX.
Okay, cool.
So I guess the answer is ask away. I'm not going to promise turnarounds, but ask away.
Thank you.
Great. Awesome. And then I just think we have a few more updates to go as we wrap up the session here. Again, thank you to all the presenters and researchers. But I have a quick message that the fun is not over yet for all of you researchers, because you are invited to, drum roll, the TE Academy Alumni Reunion. Woo! We're officially announcing this right now, and just wanted to thank everyone again for completing this. And as you have completed a research program now at the TE Academy, you're invited to our alumni reunion. And this will include alumni from all the past research programs and courses that the Academy has put on. It'll be a really exciting networking opportunity, and you can tell all of the stories of simulations and bug hunting, Henrik, that you have. So it'll be a really good time, and we are very excited to invite you. So thanks again for the contribution, and we'll see you again on Friday for sure. And Angela, did you want to add something? I just saw you on mute.
No, just wanted to mention you all get calendar invites to have all the links and everything you need.
Yes, definitely. And then keeping on the Academy conversation, we do want to make a quick plug for all of the awesome programs we have going on in the next couple weeks. For everyone in the call that, well, even the researchers, but everyone in the call that hasn't been to an Academy event yet, feel free to join. We would love to have you. We have 3 coming up in the next few weeks. First is a 3-series workshop on modeling the RIDE protocol. So we're going to learn all about the RIDE protocol and a CAD/CAD digital twin that was recently open sourced. And another opportunity is to dive into a research program similar to the one that just concluded, but on a different subject, that being the DAO reward systems. So we're going to dive into different DAO reward systems with a few case partner DAOs like Ocean and Near Protocol, and get to the bottom of DAO rewards. So we would love to have you join in that research as well. And lastly, if you're just new to token engineering and don't really know what's going on, we have our introduction to token engineering session each month. And this is being held on November 11th, I believe, is the official date. But I can drop this link in the chat. This tweet has all of the details on how to get involved with these 3 programs. And the link is also, or the registration links are also in that Google Sheet document that I shared earlier. And then the final resource for everyone is our most recent research, or most recent newsletter update. So if you'd like to read through what the Academy's been up to and finally connect with us online. Great. So that's all that we have for final presentations today. And I'll go back to this slide because, again, this is the most important part.
Yeah, big round of applause. Thanks, everyone. Awesome job.
Great. All right, we'll wrap up. We'll see you all around. Thanks for joining today.
See you November 12th.
Yeah,
To the
thanks
reunion.
everybody.
Thanks, everybody.
Thank you, guys.
Thanks a lot.
Thanks, everybody.
Thank you. Bye.
Thanks.
See you soon.
Bye.
Yeah.